Hello, sir. So we're all going to present you our first assignment on the financial ratio analysis, and we're going to talk about Accor Hotel Group, which is the first European hotel company. Benedict will start with the introduction of Accor, and then we will all analyze those ratios.
So I will start to introduce what is Accor. So Accor is a French hotel group created in 1967 by Paul Duboul and Gérard Pélisson. They want to reproduce the US model Holiday Inn with the SIEH, that means Society of Investments and Exploitation in Hospitality. The first hotel opening in Lille, a city of France, and this is a Novotel. In 1983, the international group changed its name and became Accor Group Hotel when Jacques Brel bought it. Today, this is the first international group in the world and in Europe, and the sixth one in the world, with almost 3,600 hotels spread over 92 countries. So it's developing the brand from economy to luxury. So the luxury, as you can see, the luxury brand starts with Sofitel, and on the middle you have all the mid-scale, and to finish with the economy hotels and the Formula 1. So, to study to do the analysis, the financial analysis of Accor, we calculated all the ratio. So the two first ones are for the year 2013. The two next one are for 2014, and the two last one are for 2015. So on the first chart on the top, you can see that the revenue are decreasing between 2013 and 2014 of 1.48%, but they are increasing in between 2014 and 2015 of 2.33. However, the net profits are increasing a lot during all the 3 years. So it seems important to analyze their ratio in order to highlight its financial health. So let's start with the first categories of ratio, the liquidity ratio. So this is the first part of this chart. So liquidity of a firm is measured by its ability to satisfy its short-term obligation as they come due. So regarding the liquidity ratio, it shows that the financial position became stronger according to high investments in assets, especially in 2014, which has caused a stagnancy in 2015. So that means that Accor has the ability to satisfy its short-term obligation as they come due because the liquidity ratio are higher than 1. But current assets might be too much, making that unproductive as they're not fully utilized.
So now we'll discuss about the activity ratio. So as we all know, the activity ratio measures the speed in which various accounts are converted into sale or cash, and the efficiency with which total assets are used. Activity ratio has been mostly increased during the year 2014, as you can see, with the inventory turnover, which is 8.66%. The average collection period 6.56, and the average payment period 16.71. So the stock has been converted into sale quicker throughout 2014, and then to be used in the same way as the year after. There is also an increase in the average stock, resulted by the decrease in the cost of goods sold. The demand has got higher to provide a better sale, and the debtor, they have paid the company in the shorter period of time, which has increased the cash flow of the company. This ratio highlights the Accor Hotel Group converted its inventory, debtor and creditor account into a sale and cash, in the speedway. However, with more than 20% drop, the asset has dropped of 20%. and it's because it's being too high, and so it means it hasn't been efficient enough to generate the sales.
So now it's time to present the DEBS ratio, and DEBS ratio measures the proportion of total assets financed by creditors. DEBS ratio figures indicate that the company financed close to half its assets with DEBS. Fine, DEBS ratio here. The higher this ratio, the greater the firm degree of DEBS and the more risk it has. The ratio decreased year on year, as you can see 2013, 2014 here, with a variation of minus 4.77, and 2014 to 2015 with a variation of minus 0.31. As the risk become lower and lower, AHG to enjoy more benefits in order to pay off its interest as well as its ability to meet all fixed payment obligations.
Okay, so now we are going to talk about profitability ratio, which are here. So profitability ratio, is a measure of profitability, of course, which is a way to measure a company's performance. Profitability is simply the capacity to make a profit, and a profit is what is left over from income earned after you have deducted all costs and expenses related to earning the income. So while watching the profitability ratios, we can observe a small increase in the given figures here and here. However, there aren't a lot of variation between these data, whereas the revenue and the net profit increase every year. Labor and raw material are using efficiently. In fact, the gross profit margin is approximately equal to 32% between 2013 and 2015. And the average gross profit margin for the sector in the world is around 33%. And now net profit margin had increased from 2.3% to 4.37% in 2015. This change is due to the drop of interest, which were 894 million in 2013, 849 million in 2014, and to finish 794 million in 2015.
Okay, so then we have different other profitability ratios, which are returns on common equity and returns on total assets. So the second one here measures the return on the common stockholder investment in the firm. So as you can see, in 2015 here, the company gets 6.49% of profits. So the ROE just increased from the first year to the third year. And this result seems to be low, but probably more profitable than financial investment. So we will also put the figures in a context after economic crisis. Also here, the return on total assets ratio, it measures the overall effectiveness of management in generating profits with its available assets. So in 2015, for an account of about approximately 8 billion euros of total assets, the company generates 2.72% of profits. So we are still in a crisis situation, and the losses of financial assets, losses of financial assets that decrease the profitability of share capital. However, this ROA is getting better year on year, and they are going out of the crisis. Then after that here, as you can see, we've got the market ratios. So we've got price earning ratios and market book ratios. The first one relates the firm's market value as measured by its current share price to certain accounting values, and the price earning ratio decreased a lot between 2013, as you can see here, to
2015. So they lost between the two first years about 28%. Because of the increase of the earning per share and market price per share of the common stock. However, this average of price earning ratio is around 23 euros for the hotel industry in the world. So, despite of the decrease, the price earning ratio is still good because it's still between 53% and 37 euros. Sorry, not percent, euros. About the market. About the market book ratio here, the investors view the good firm's performance as 2.48 in 2015, which is a very good value. So to finish with this analysis, let me convert the 1 million of frigates equivalent to 215,000 euros. So thanks to our analysis, we noticed an improvement since 2013. The net profit was getting better between the 3 years, and based on the market ratio between 2014 and 2015, we can see the higher performance and growth in the future of this company. However, as investors in this kind of worldwide company, it seems that this amount to be invested is not an important amount of money regarding to the capitalization, which is about more than 11 billion of euros. But if our team have had to invest in Accor, we will definitely do it because Accor is always in expansion and they used to open new brands. So despite of the crisis, the group stay first in Europe and will be better years after years. Voilà, thank you.